Greetings from 3Edge Asset Management, and welcome to our latest 3Edge quarterly webinar. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and I'm joined here today once again by Steve Cucchiaro, the CEO and Chief Investment Officer here at 3Edge Asset Management. We've created today's short video exclusively for the independent advisor community. We'll briefly review 2024 and provide a summary overview of our outlook for 2025. We know that as independent advisors, your time is extremely valuable, and so our hope is that you will find that this brief video will be informative and helpful in better understanding the current investment environment. Before we begin, just a brief update and overview of our firm. We continue to grow, and by the end of last year, we reached approximately $2 billion in assets between AUM and AUA. And we find that most advisors use our 3Edge core strategies, 3Edge Conservative and Total Return, as diversifying strategies and in combination with other strategies and strategists in mixed model portfolios. At 3Edge, we pursue what we describe as a dual investment mandate, whereby we seek to generate investment returns while simultaneously seeking to keep our clients safe through our approach to risk management, whereby we seek to smooth volatility and manage portfolio declines. Our investment approach features full-time, broad asset diversification. In addition, our portfolio management approach is dynamic, and we adjust our portfolios as our outlook for the global capital markets changes over time. And we construct portfolios through the use of index ETFs. As I mentioned earlier, the 3Edge core strategies are most often utilized as diversifying strategies as part of advisors' mixed model portfolios. In that regard, we continue to collaborate with other investment strategists on numerous TAMP platforms in creating model portfolios on behalf of advisors and their clients. Lastly, we also continue to focus on developing thought leadership capabilities through our 3Edge YouTube videos series. Our viewership and subscriber base for our weekly videos continues to grow. We continue to hear from listeners about how they value our videos as a way to remain informed as to what is going on in the market, as well as what we are thinking here at 3Edge. Before I turn things over to Steve, I'd like to drill down a bit and look at our 3Edge conservative strategy, which more and more advisors are utilizing as a complement or a substitute for core bonds as part of their model portfolios. In 2024, 3Edge conservative outperformed both the 7 to 10-year U.S. Treasuries and the S&P Aggregate Bond Index. The first row of this table shows how 3Edge Conservative has outperformed the Aggregate Bond Index by over 200 basis points per year on a compound annual growth rate basis since inception. In the second line in the table, we see that not only has 3Edge Conservative outperformed the Aggregate Bond Index, but it has done so with less than one-third the risk as measured by maximum drawdown, which again we can see on the second line of the first two columns in the table. And this is just one example why more and more advisors are utilizing our 3Edge conservative strategy as a replacement for core bonds in their model portfolios. This next slide simply provides an illustration of one example of how 3Edge strategies can be combined with other strategists in mixed model portfolios. This example of our collaboration with Main Management, where we can see 3Edge Conservative paired with Main Management's active sector rotation strategy in model portfolios across different risk and return objectives. So with that, I will now hand things over to Steve, who will provide a brief review of 2024, as well as our current market outlook for 2025. So Steve, take it away.
So to begin the outlook, I think it's important to recognize that the year 2025 follows a year of unusual extremes, and that was 2024. And despite the high level of uncertainty that existed throughout the year, there was not one market correction during the year, correction being defined as a peak to trough drop of 10% or more. That just didn't happen at all in 2024, and that's really quite unusual. We had the most extreme market concentration in history, even more extreme than the tech stock bubble. And by that, I mean relatively small number of companies responsible for the lion's share of returns, and that certainly happened last year. And again, if you analyze market bubbles in history, that seems to be a common pattern or common theme. And then finally, and maybe most importantly, a measure of overvaluation that has proven to be very reliable over the long term, which is looking at the price to sales ratio. That is at an all-time record high by the end of 2024. So all of these are very important to indicate that it was a very unusual year last year and sets the stage for 2025. Now, if we look at the price to sales ratio graph over the last century, we see that we're not only at an all-time peak, but when we look at past peaks, they coincide with past serious corrections. The first peak you see happened in 1929. We had the roaring 20s. We had people that thought the stock market would climb forever. Permanently high plateau was often cited. And yet, when the price sales ratio got so extreme, it finally peaked. And then we had the crash of 29 and the Great Depression. We had another peak at the tech stock bubble, and then that burst. And then we had further peaks, one at the end of 2021, and that led to a big down year in 2022. And now also a new peak at the end of 2024. So this calls into question that while we all know market bubbles can continue for far longer than logic or fundamentals would suggest, when they finally do correct, the corrections can be extreme. And just to look quickly at some past corrections, when price to sales ratios were abnormally high like they are now, one was the internet bubble, and that market from peak to trough fell over 83%, the NASDAQ 100 index of tech stocks. And it wiped out over 3 years of rally up until then. So people felt very smug about leading into the rally and looked down upon people that were worried about overvaluation. But then, of course, the markets do correct. Japan, we had a situation where price sales ratio got out of hand, but people kept thinking that we had, at that time, Japan exceptionalism. Everything Japanese was really held in high regard. The market peaked in December of 1989, and it took 35 years to recover on a price basis and wiped out the preceding 3 years of rally. And then finally, the roaring 20s, the bubble burst in 1929. Those stocks fell over 86% from peak to trough, wiped out 7 years of rally leading up to the peak, and it took 25 years to recover. So we take these periods of overvaluation seriously. It doesn't mean the market's going to correct tomorrow. It does mean eventually it will correct, and we want to make sure we're on the right side of that major move. Now, why did the market do so well last year? Well, first of all, because of the market concentration, it was a small part of the market that did extremely well. And that small part ended up being a bigger part of some of the major indices to pull the indices up as well. But largely, it was the crowd psychology overwhelmed fundamental value. Next, we had meme stocks and meme crypto coins that were created out of thin air and added billions of value in a few days. We had the introduction of and popularity of 0 days to expiration options, meaning that people were betting on what would happen between some part of the day and the market close, which is, one could say, akin to gambling. So all of these are extreme measures of animal spirits, investor enthusiasm, irrational exuberance. You have different names for it. And I love this quote from Warren Buffett referencing his mentor, Benjamin Graham. In the short run, the market is a voting machine. In the long run, it's a weighing machine, meaning that psychology rules the day in the short term, but eventually all excesses will be corrected. Next, I want to show how during this rally, again, from February of 2009 until present, we've had a tremendous gain in earnings, and that's in the orange. Earnings per share of the S&P have grown 4 times. That's a tremendous amount of gain. A lot of those gains, actually, a study was done that showed that a lot of the gains came from the tax cut, which helped after-tax returns, and the very low interest rates we had in 2020 timeframe, where a lot of firms refinanced at very low rates. And that helped the lion's share of these earnings gains. But nevertheless, 4 times the multiple. That's tremendous. The blue line shows, however, that stock investors were so excited that they created an 8 times price per share gain over the same time period. We know over the long term, both of these have to equal. You're buying into stocks, you're buying into earning streams. Your appreciation of the price is exactly what the appreciation of the earnings is over any long period. But in the short period, investors can get exuberant or panicky. And this is an excellent demonstration that investors get way ahead of themselves. Again, this could continue and this gap could grow for a while longer, but eventually this gap will narrow. On the other hand, we know the market's overvalued. And we know that with our models and our research and our investment committee, we are watching some definitive signs that will be warning signs or flags that will tell us that the end is near. It's time to get more defensive again. One would be rising bond yields and the return of the bond vigilantes. We know that that could kill the market. Next, credit spreads are near all-time record lows. And when credit spreads start to widen, that's an early warning signal that trouble is ahead. Third, no one knows yet if tariffs are more of a bluff and a negotiating strategy or if they will actually be implemented. But in the past, when they were implemented, they didn't create the gains that were hoped. They caused retaliation by other countries. And it turned out that all countries ended up losing. And rather than a zero-sum game where I win and you lose, it turned into an interconnected market where everyone lost. So that's something we have to watch. Next, geopolitical conflicts. While we have a temporary ceasefire in the Middle East, we know that that could cease at any moment. And if things get more escalated there, oil prices spike, well, the bull market is over. Unemployment has been very low for a long time, but we know from the past that periods of low unemployment usually precede the next downturns. So if we see a rise in unemployment, that could be a signal that economy is ready to slow down. And finally, the yen carry trade has been responsible for a lot of capital coming into the stock market, into our stock market. And people all over the world have been shorting the Japanese yen and using that as leverage and capital to then buy into the U.S. stock market. So finally, I want to wrap it up. I want to wrap up our investment strategy and outlook by saying that in the short term, there are 2 possible scenarios. One is that this market bubble continues well into the year. And the second is that a major correction is imminent. And these are both still possible. There's still factors that could drive the market in either direction, and we're watching them closely as you saw. But given all the uncertainty, we will invest in equities, and we will have participation in those equities that will continue to do well if the bubble continues. However, we do it with caution. We do it with watching very closely the warning signs, so we won't hesitate to pull back when it looks like this correction is finally getting underway. Second, we think it's really important to hedge the equities, not traditionally like people have done in the past with long-term bonds, but in a very targeted way. Long-term bonds had a tremendous bull market that ended in the summer of 2020. Since then, the bond market, as Fritz mentioned, has done terribly, and they no longer serve as an excellent hedge against an equity portfolio. We much prefer gold, commodities, and tips as a much better, more targeted hedge against the possibility of more geopolitical risk, against a second inflation wave, against stagflation. And we also have shorter-term U.S. Treasuries, which do not have the duration risk, which can act as dry powder to come in and buy stocks when they're at a bargain after the next correction. Fritz, I turn it back to you.
Great. Thanks, Steve. Thanks for providing our outlook for 2025, as we all seek to navigate a great deal of economic and market uncertainty to begin the new year. So that will do it for Steve and me. If you'd like to find out more about our firm and how we work with independent RIAs, please reach out to the relationship managers shown on this slide for whichever part of the country where you may be located. We'd welcome an opportunity to discuss ways that we may be of assistance. So, on behalf of Steve and everyone here at 3 Edge, thanks for listening.